Let's get to our Fed panel now for what they expect and what they'll be listening for from Chair Powell today. Paul Christopher is head of global investment strategy at Wells Fargo. Carl Tannenbaum is chief economist at Northern Trust. And Nisha Patel is here on set with me. She's FMA fixed income portfolio manager at Parametric. Welcome to all of you. Nisha, what are you listening for? What are your expectations? What's important to the market here?
Yeah, I think Steve put it well. I really think there's really two options on the table here, right? Either hold or cut rates. I'm in the hold rates camp. I think you still have too much uncertainty around tariffs, where that actually lands. April 2nd is a big date on where there's more transparency on the framework, but it's exactly that. It's just a little bit more transparency. We don't ultimately know where the tariffs end up and what that impact is. So I think with maybe some softer data, yes, has been weaker. We haven't really seen that in the harder data.
Right.
Inflation has actually been moderating, and that helps the Fed. So I think you have them saying, look, we don't see anything right now that's warranting us to take any action. Perhaps they take back some of the very pro-growth, kind of stronger language on the economy to help them adjust for a May meeting where that can really kind of set them up possibly to start kind of shifting more towards a cut narrative if that's ultimately needed if we see weaker data from now until kind of that May meeting.
But that's the bias you would expect is kind of preparing the way for maybe a May cut, depending on how April 2nd goes.
Yes.
So how many cuts this year do you think?
As of now, I would say two, but again, like a lot of this just ends up on where the tariffs ultimately end up, right? I mean, if the actual end outcome is a very marginal impact for the U.S. economy in terms of it being inflationary.
Right.
And you have more of a softer landing scenario, economic data holds up well. You know, keep in mind, we're coming from a very strong economic foundation. So things would need to deteriorate pretty significantly from here to warrant, I think, any more than kind of the two cuts that are not saying it's possible,
right,
but any more than the two cuts that are roughly being priced into the market. So I would say probably two. But certainly that could be repositioned to be higher if things do possibly deteriorate in the hard data.
Paul, you guys are at 3. Is that because you see more of a slowdown here?
We're at 1, actually.
Sorry,
and we do think that the economy... The economy, we think, will remain solid this year, and we expect inflation in that 3 to 3.3% range, where we think companies can make money and valuations can hold up. So we would expect stocks to do well then on the back of that strong economy, and then we would expect long-term yields to rise, and that would really help our pick favorable on financials.
And Carl, you guys are also in the one-cut camp?
We are, and after assiduously avoiding the subject of tariffs and press conferences so far this year, both to remain apolitical and also because the details weren't available, that topic has to be on the table, both embedded in the forecasts and also discussed in the press conference. In addition to their impact on the baseline, where we see inflation higher and growth lower, the risks towards higher inflation, I think, are still going to be stressed in the summary of economic projections. Tariffs look like they're going to be higher for longer, and we still haven't had the other angle on inflation, which is the immigration policy fully fleshed out by the administration. And so if they want to remain cautious about inflation, which I feel that they will, it doesn't look like we're going to get another cut for a number of months.